Hello, everyone. Welcome to video one of the last chapter of this course. This chapter is chapter 21. It focuses on discussing GST and HST, which is sales taxes, as they're administered in Canada. This is an intro video. I'll kind of give the sales tax rates throughout Canada, talk a bit more about the concept of sales tax and how it applies to tax revenue. But future videos, we will do the actual calculations and figure out how much is owed from sales tax, GST, HST collected. So let's get into the lecture. So the goods and services tax was introduced in Canada in 1991. When it was first started, it was 7%. By 2008, it had been reduced to 5%. So GST, the goods and services tax, is a federally run sales tax. So the G can be for government sales tax. It means goods and services, but I just remember GST is the government sales tax. And there's a secondary layer, PST, which can be applied from each province. So the full sales tax that is applied on certain goods and services is actually different depending on which province you live. So the intent of GST developers was to amalgamate the goods and services sales tax with the provincial to create a harmonized sales tax, also known as HST, and eliminate dual administrative systems. So it takes time and effort to review accounting records to administer sales tax collected at the both provincial and federal level. So provincial sales tax had already been in place. The GST came into place, and the federal government hoped that the provinces would amalgamate both these sales tax rates. And so, pretty much one sales tax would just kind of be administered across Canada. The only thing is, not all the provinces accepted this. The HST only really applies in Ontario and the eastern coast provinces. The Alberta charges no PST whatsoever, nor does the territories. So I think the next slide goes through, yeah. So the next slide goes through the actual sales tax rate that applies in each territory or each province, sorry. So the East Coast provinces, New Brunswick, Newfoundland, Nova Scotia, Prince Edward Island, and Ontario, uses the HST. So this chart's slightly wrong because Ontario's combined rate, so HST was supposed to be the federal rate and the provincial combined. So the federal rate of 5% plus the provincial rate of 8% in Ontario combines to make 13. So Ontario's rate is actually 13%, but the rest of these provinces do apply 15% to consumption purchases. Quebec files the QST, which combines that federal rate of 5% with 9.975. So it's just short of 15% when you combine them. But Quebec administers both these sales tax themselves. So they administer on the provincial level. By having the HST apply, these provinces all have their sales tax administered at the federal level. So in Ontario, when you file an HST tax return, you file it with the CRA at the federal level. But if you were to, say, deal in Saskatchewan, you would have to file a GST with the federal government and a PST provincial return with Saskatchewan because they administer it separately. Alberta and the territories only applies the GST rate, so they only apply 5%. Their provincial rates are 0%. Since GST is all they're charging, that's the federal portion of the sales tax, so it's also administered at the federal level. Only British Columbia, Manitoba, and Saskatchewan maintain their PST, their provincial sales tax, separate from the goods and services. So they apply it both federally for the 5% portion and provincially for their provincial portion, whether that's the 7% or the 6% for Saskatchewan. So these charts show all of the provinces and the applicable rates with a small correction to Ontario. But for this course, we're going to focus on situations where either only the GST applies, for example, Alberta, or if the HST applies. So we're going to focus on the sales tax items that are specifically administered at the federal level. CPA competency are their expectations when it comes to sales tax. A level C, meaning at least comprehend the function of sales tax, be able to explain, describe, and demonstrate that knowledge. From a low to moderate complexity. That being is the standards for descriptions pretty low. Understand that sales tax is a transaction-based tax at the time of sale. But level B is for compliance related concerns. So they don't expect too much as far as a encyclopedic knowledge of sales tax. They really expect a practical application of sales tax, how it's applied in Canada. And if you were to take, say, the CPA Ontario exam, they would probably look at your ability to practically complete an HST return. So compliance related concerns. Make sure, when's the due date? Are you filing a return? When is payment due? Stuff like that. So overall in the deal of this textbook, HST from the CPA competency levels is somewhat lower priority, but we do want to make sure that you have the wherewithal in understanding where those numbers are coming from and how to execute them on a HST return. So why do we apply HST? So GST and HST are transaction taxes. They're not income tax. When we file a tax return, a personal tax return, we are reporting all of the money we made in the year, and then we have to remit a portion of that money to the government, even if we don't use it. If it just sits in a bank account, because we earn that income, we pay taxes on it. Sales tax is a transaction tax, which means it gets applied when a transaction takes place. It occurs when you consume the money you've earned. So if I buy a laptop, if I buy clothes, if I take a trip, if I go to a restaurant and buy food, they will apply sales tax. Those are points in time where I'm using my money. So the support to include transaction-based taxes is it's much simpler to apply than income tax. Income tax, there's a lot of paperwork in compiling your income and reporting its total and calculating income tax at that rate. For transaction taxes, it's very simple because my laptop was $1,000. So I apply sales tax of 13% in Ontario to the $1,000. That's $130. There's my tax portion. So it's calculated at the point of sale and it's just remitted while the transaction's taking place. So that tax portion's collected by the company that I'm dealing with, and then that business, that company, that will remit the tax on your behalf. So relatively speaking, it's a very simple way to charge and collect taxes. Incentives to work, there's this general feeling or idea that when you have a progressive tax system, because the more money you make, the higher your tax rate, that is disincentivizing working. I want to make a certain amount of money, but since I'm only going to be able to keep, say, 50 cents of the next dollar I make, maybe I don't want to take on the extra work. The idea being that perhaps the return of that extra effort might not be there. But because transaction taxes applies only to money used, it doesn't have that disincentive to work. It has an incentive to work because I still want to make money in order to be able to buy myself things. So it's consistently applied. It's just 13% in Ontario for items that we buy. So if I don't want to pay that tax, I simply don't buy those things. But if wanting to own those things, or if I want the clothes, if I want the laptop, and I want to buy it for myself, then I have to include a tax portion. There's also, it keeps tax revenues in Canada because the purchases are geared around products and services provided in Canada. The taxes are remitted and collected by often Canadian businesses and collected by the Canadian government. The potential disadvantage is when we consider how tax rates are affecting an individual, we apply, well, how much tax did they pay compared to the overall their financial situation. Basically, what amount of taxes do they pay compared to their total amount of money they have or earned? So when I buy a laptop, if my income's only $50,000, that extra $130 affects me more than if my income was $100,000 or $150,000. So if I made $150,000, buying a laptop and paying $130 in taxes doesn't affect my overall financial output, my overall financial situation, as $130 might affect someone who only earns 50, 40, $30,000 in a year. So because that $130 makes up a larger portion, a larger percentage of my overall income, it's considered to be a regressive tax. Lower income individuals spend more on consumption. Result is transaction taxes represent a larger portion of individuals' income. So there's also the aspect that someone who has there's a certain amount of money spent for our day-to-day living ability. So we spend for rent or mortgage. We have to buy food. We have to buy clothes. If I need a laptop for work, I need to buy it. So a larger portion of my income is spent on those needs. Whereas if I have a much higher income, once a portion of my income spent on needs or even my wants, a large portion of my income is more available for investment or for putting away or for saving. And so it's not being spent, which means that portion of my income is not getting taxed. That's also the other side of it. So sales tax are at their core a regressive system, despite consistently applying a 13% rate to all individuals, because it affects lower income individuals more, it is a regressive tax. So types of transaction taxes. So in this example, let's say we have a customer is buying something from a retailer. That retailer must have bought that product from a wholesaler who would have bought it from a manufacturer. So this product is making its way through these steps. So the cost of the manufacture of a product is $4 per unit. The wholesaler buys each of those units at $10. That wholesaler sells 800 of those units for $25 to a retailer who sells it for $50 to a customer. So we know that a product goes through these steps from, they classically call them middlemen. The manufacturer makes something, the next wholesaler business buys it, then to retailer. So for every step it goes through, its price will increase. And when it eventually gets to the customer will purchase at its full price. And that price is somewhat recovering all of the various costs from the intermediary steps. So how do we apply sales tax in this situation? The simplest form is single stage transaction tax. This is commonly called retail sales tax. This is applied at the customer level. So something can be made, go through all the steps, and then when it's sold to the final customer for $50, that customer pays the sales portion. If in the example the transaction took place in Manitoba, a 7%, that's the provincial portion of the sales tax, would be assessed. So if we bought 1,000 units at $25, that's $25,000. 7% of that amount is $1,750. So we would spend $25,000 plus the $1,750 to make up that tax portion. So one transaction, that's where the sales tax is collected. The only thing is, how do we know that that purchase is the final purchase in the step? If this customer ends up having a personal business, maybe they take that product or they incorporate it into something else and sell it along. So identifying when that product has reached the end of its retail cycle, how do we know to apply the single stage transaction? How do we know when it's reached that final point, that final customer to pay the sales tax? The easier way to go about it is this multi-stage transaction task, where we apply the sales tax at every step along that process. So we would apply the sales tax at every step along that process. So when the customer buys it at the end and doesn't sell it along, the process has come to a close and we've collected all the available sales tax. So we don't have to wait for that final transaction because the sales tax is sort of being dealt with at every iteration. So in example, It's possible to impose multi-stage transactions at any combination of levels. So we could apply tax at the wholesale and retail, but not manufacturing. We could apply at manufacturer and wholesale, but not retail level. So multi-stage transaction can apply at specific levels or all of them. Tax can be applied at each stage turnover tax. The difficulty with turnover tax is if the wholesaler has to pay additional tax when they purchase $4 per unit, that adds to their cost. So the wholesaler is likely to add that cost base, apply a profit margin, and include it in the price. So the price would go from $10 to say $11 to account for the additional sales tax. The retailer pays the $11 and then they'll apply their profit margin. So their price goes from 25 to 27. The customer eventually buys it for 50, but to account for the additional taxes, perhaps the cost base is now 55, and now they're paying taxes on 55 instead of 50. So this process is called pyramiding, where the tax that would be assessed on previously assessed tax. So basically saying is now my taxes that I'm paying is not just for the price of the product, but also including a portion of the tax that was applied to it in a previous level. So I'm kind of paying tax on tax. So we usually use a process of value added tax. Value added tax says, well, instead of applying a tax for the entire price portion to try and stave off that pyramiding problem, what if we only apply tax to the change in value between when, say, the wholesaler purchased it and when they sold it along? A counts-based method is tax assessed on basis of value added at each level of production development. It's based on accounting-based determination of income. Canada uses a similar function, but this is invoice credit method, where tax is assessed on gross sales and the vendors charge taxes on full selling price, but that tax is offset by the input tax credit. So how that works is I mentioned before that, so when the wholesaler sells to the retailer for when the wholesaler purchases the units for $11, they don't need to increase their price for that additional dollar because when they sell it to the retailer for 25, they'll collect, let's say, $2 of sales tax from the retailer, but then they get to remove or deduct from that taxes collected the $1 tax spent. So they don't need to include the sales tax into their price to recover it. That recovery is accounted for in that value add, in that difference calculation. So invoice credit is basically focused on when did we collect the sales tax or when did we pay it. So here's the example for it, and then I'll go through the exercise. So accounts-based VAT is looking at the difference in value. So the raw materials were sold for $4. There was 1,000 units. So if the sales tax rate is 5%, which is our GST tax, 5%, so 1,000 times $4 each is $4,000. 5% of that is $200. So that VAT, that sales tax would be collected $200 on that sale. The manufacturer, when he sells to the wholesaler, will sell it for $10. Now, the price difference between $4 and 10 is 6. So if they bought it for 4 and sold it for 10, they must have added $6 worth of value. So the 1,000 units times $6 of value added is $6,000. 5% is another 300. Again, so the price went from $10 to 25. So the next rank must have added $15 of value, right? So the wholesaler, when they sell for $25, must have added 15, and the retailer added $25 of value. So we go through that example. The $15 added going from 10 to 25 times 800 units sold at 5% is an additional $600. Retail to consumer, $25 of value added times 500 units sold, 5% is 625. So the government collects sales tax at each step along the process. So in total, they will have collected $1,725. That's looking at just the value added, the difference of price at each rank. Now, this is somewhat different from the Canadian approach. The Canadian approach looks at invoice credit. So the raw material supplier sells to the manufacturer for 1,000 units at $4. So 5% is collected $200. The manufacturer sells 1,000 units at $10. So the full GST collected, 5%, is $500. And then they get to subtract the sales tax that they paid. Since they paid the raw material supplier $200, they only have to pay the difference, $300. Now, so far, that's the exact same as our prior example for the accounts-based. Accounts-based, 200, 300 for just those value-added changes. When that $500 got sold on to the wholesaler sold the 800 units at $25. GST collected was $1,000, but they got to deduct from this $1,000 the $500 that they paid the manufacturer. So since the manufacturer collected 500, so the wholesaler must have paid that 500, so they only pay the difference, 1,000 minus 5. And then the retailer who bought those units for $800, they spent the $1,000 of sales when they bought the materials, the product, and then they sold it on to the customer. So GST collected was 1,250. They paid $1,000, so they get to subtract the difference at 250. So when we add up the different stages, 200, 300, 500, 250, now the total tax collected is $1,250. If you will recall, when we did our example for just the account-based, it was 1,725. So the Canadian approach actually collects fewer or a smaller amount of sales tax. And the reason for it is when we do the accounts-based change, it's affected by the units sold. So the wholesaler is only getting credit for the sales tax already collected for the units that they've sold for 800, but they purchased 1,000 units. Now, this happens when we buy various units and maybe we combine them into a product for resale, or we've processed them to the next stage. But when we reduce the units, we reduce our recovery of the sales tax. So the accounts base is only looking at the value change for the 500 units sold. However, for invoice credit, each layer is getting credit for the entire amount of their purchases made. So the retailer gets a GST paid on cost, or an ITC, an income tax credit, of the full $1,000 because that's what they paid for. So the fact that they sold 300 fewer units doesn't matter because they still get credit for the full 800 units. So the reason 200 and 300 stays the same in both systems is because both stages use the same amount of units, 1,000. When you change the units, you change this outcome. Whereas invoice credit doesn't really care as much about the units, they care about how much did you pay. Okay. Yes, so one more slide and then we'll get into the exercise. So observations of the Canadian approach. Invoice credit method results in less tax being paid, which we observed. The enterprise receives ITCs for all purchases, regardless of if sold or not. The ITC claimed for government on units purchased. Taxes collected are based on units sold. Net result is government does not benefit until the sale is made to the end consumer, and the Canadian approach is income tax neutral. So it's based on trying to get a product from its inception, its creation, from raw materials, through the process, and the customer is the eventual, it's the eventual end collection, which means the sales tax you pay when you purchase something from a store, that's the final amount of tax that the government will eventually collect. The sales tax paid and collected through the companies are returned to the company. The manufacturer collected $500, but that $500 was a credit for the wholesaler. So as it moves through businesses, the amounts collected and paid are just an in and an out. The wholesaler collected $1,000, but the retailer gets the ITC for that $1,000. So the only sales tax that's really kept and held by the government is the eventual amount paid by the customer, that $1,250. So the GST collected by the retailer, $1,250, is the net tax at the end of the retail cycle, at the end of when the customer paid it. Okay, let's go right into the exercise. So alternative VAT approaches, at the beginning of the year, the cost of the opening inventory of Darwin wholesalers was $180,000. Darwin purchased additional inventory of $233,000 during the year. Sales during the year was $416,000, and the cost of inventory sold was $264,000. All of these amounts were before the addition of sales tax. Assuming a sales tax rate was 5%, how much sales tax would be paid by Darwin under an accounts-based VAT system and an invoice credit VAT system? So accounts-based wants to look at the value added between the cost of inventory and what was sold. So we'll be taking 5% of the difference between 416 and the cost of inventory of 264. But the invoice credit system wants to see, what did you actually pay? We paid 5% on the inventory purchase, 233,000, and we collected 5% of 416. So in one system, we're looking at the difference between 416 and 264, and then in the other system, the difference between 416 and 233. So when we do each system, our sales is 416 in both situations. The cost of the account-based system is the cost of inventory sold, 264,000. So the value added was 152,000. 5% of that is $7,600. That's what Darwin owes the government. Under the Canadian system, the total sales is 416,000, 5% being 20,800, but we are including the credits for sales tax paid this year. When we purchased $233,000 of inventory, we paid $11,650 of sales tax on those purchases. So those amounts paid is our input tax credit, 20,800 minus 11,650 means we owe the net sales tax collected is $9,150. So Darwin will pay this amount of dollars to the government. Okay, so that's my intro and the alternative VAT approaches for sales tax. When we come back, we will be looking into the liability and identifying supply categories for sales tax, and then we'll also talk about the requirement for registrations. Depending on the length of the video, maybe I'll split that into two, but right now we're going to see if we can do it all at once. So thank you for your time. See you in the next video.